and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
What I think you'll see coming from Powell and the Fed this week is, some more time, some more patience, and the prospect potentially for a rate hike, not a cut. And I think that is something that the market is incredibly focused on.
What Tesla certainly has to do is stay on the forefront of innovation. They have to be the most technologically advanced car option because they can't compete on price because of the dynamics of the Chinese market. Tesla needs to make a profit, unlike a lot of these Chinese firms, so it can't compete in an even field. It needs to stay on the top of the technology ladder. This allows it to stay on top for a little while longer.
And this is late stage legacy media at its worst. Bob Bakish has been in charge of Paramount for a number of years. He has been trying to guide this, very leaky ship into a calmer waters, and it's just not happening. He has lost the confidence, lost the faith of controlling shareholder Sherry Redstone.
We have got an hour to go until the market close. Let's take a look at the major averages sponsored by Tasty Trade. We start with the Dow here, which has had a little bit of bouncing around today, but in a narrow range right now, up about 1/5%. The S&P 500, very little change here. It has taken a little bit of a leg lower as we've headed throughout the session. The Nasdaq also very little changed on the day. We continue to watch what's going on in the bond market as well. There we see bond yields trending lower, but it has not served to give stocks a lift. Of course, a lot of the focus remains micro versus macro. We're going to talk more about Tesla in a moment here and the effect that it's having. But I also wanted to check just quickly on another stock that we are watching. You just heard it mentioned. I'm talking about Paramount Global. Reports that Bob Bakish may be out as CEO. This, as of course, the company has received several buyout offers that Sherry Redstone is considering, as is the board and shareholders. And meantime, it reports its earnings after the close. Now, amidst all of that, the shares are up by 3% today. So that's a stock that we are focused on. Just a quick look at sectors here as well. We've got communication services down the most today, off by 1.4%. Consumer discretionary and utilities are up the most. So not really a big theme here that we're seeing in terms of rotation or what's doing well and not on a sector basis, Josh.
Julie, Tesla has finally received the long-awaited full self-driving approval in China. This coming following Musk's surprise visit to Beijing this weekend. And joining us now for more on what this means for the EV maker, let's welcome in Wedbush Managing Director and Senior Equity Analyst Dan Ives. Dan, it is always great to have you on the show. So I'm looking at this stock, Dan. It is just roaring higher on this headline. Let's start there, Dan. Does that reaction make sense to you?
I think it makes complete sense. Because look, Josh, this is a watershed moment. For Musk to get FSD in China, it's a game changer. This is something years in the making. No investor thought this was going to happen for the next year. He gets back on that plane from Beijing, drinking mimosas. This was a trophy case win.
Dan, why though? Because all of the other electric vehicle makers that are already competing with Tesla in China, they already have autonomous driving capabilities that have already existed. There's been, of course, price wars going on in China and stiff competition from those other electric vehicle makers. If I'm a Chinese consumer and I'm thinking about buying a car, is FSD really the thing that's going to be pushing me over the edge to buy a Tesla versus a BYD or another car?
Yeah, it's a great question, Julie. I'd say there's two reasons why this is so important. One, FSD, the autonomous vision, number one, in our opinion, being Tesla over the coming years, they needed China. In terms of just from a data perspective, when you think from an AI angle what they're doing, they needed China.
But we don't know if they can use,
but
sorry to interrupt you, but we don't know if they can actually, how they can use that data, right?
Well, yet. But ultimately, if you look what Musk's been able to do, remember years ago they said he'd never be able to build a factory in China. Now look at Giga. The point is they need Tesla as much as Tesla needs China because it's the trophy case. You look at Apple, you look at Tesla, two of the best brands in the world. That's why they allowed this with Baidu as a partner. And the reason it's so important is that Tesla almost had one hand behind its back, not having FSD in China. Now they have that. And I believe what's starting to get factored in here is a demand. I'm not saying the next week or two, a demand recovery in China. But betting against Musk, it's like betting against Brunson in the playoffs.
And Dan, ultimately, it seems like, if you're a Tesla bull, are you excited because you ultimately think, listen, this potentially, the impact this has on subscription fees, on maybe even licensing this software to OEMs? Is it a margin story, Dan?
Yeah, John, I think two things. One, when you look at Tesla China, it expands the TAM. What they're going to be able to do there from autonomous, not just about the next 6-12 months, especially with Baidu. Where does this go over the next 3-5 years? I mean, when you think about robo-taxis and the autonomous vision. Two, this shows you're really starting to see Musk and China, that relationship get tighter and tighter. And that's a great thing for the stock. That's important because, as we all know, that's been the biggest overhang here. And that's why right now, the bears on Tesla, which so far have won this year, they're going back into those hibernation, into the caves.
Dan, it's my understanding, and maybe, I don't even know if you know this, but maybe if you do, we talked a few years ago to one of the other Chinese automakers who had some autonomous driving capability. And it's my understanding that the regulations are a bit different there, that you have to sort of take a course, right, before you can get an autonomous vehicle or partially autonomous vehicle. Do you know about that? And is Tesla going to be subject to that as well?
Yeah, look, I think these are things that all need to come out in terms of the next steps. But I think the important thing is this is a broader global vision. And I think for China, this is almost a shot across the bow at the US in terms of on FSD. You could see them on the fast track versus what's happening here. And Tesla, that's the golden goose. They're going after China. They needed FSD. It's a key part of the long-term story. And when you see the stock up, I believe it's just the start of the longer-term vision now taking hold.
And Dan, I'm interested why you think, China decided to, in fact, greenlight this tech. Do you think it's because, officials over there, Dan, maybe they just believe that FSD is ultimately relatively safer over the long term? Do you think they were trying to extend maybe an olive branch to the U.S. as tensions are running hot? What are the reasons you think they greenlit this?
Yeah, I think it's all the above. And you have the most followed human in the world in Musk. And Musk being in Beijing, not just a photo op, that's what China wants. China wants that relationship to increase, just like they do with Apple as well. And when you look at FSD, they're going to double down on that. And you cannot double down on FSD if Tesla is not involved. And that's why I think Musk went there on the surprise visit this weekend. And he comes back with just a huge win.
Dan, so Tesla's sales in China were down almost 4% in the first quarter, while the rest of the market there was growing. And I know you sort of cautioned that this is more of a long-term story, but do we see a turnaround in the fortunes of China sales for Tesla this year?
Look, I think you're going to start to see what I believe. I'm not saying the next month, but as we get in the second half of the year, I think you see a rebound in China sales. And I think Tesla has a number of things up their sleeves that they're going to introduce in China, which will be significant. And it goes back to, as someone that's been in the region many times, massive competition, such impressive, vehicles that you see there from OEMs. But there's one Tesla. And at the end of the day, you're going to see a lot of consumers. They want to be driving a Tesla, not just in China, but in the US, Europe. And that's why I believe they are just going through a digestion period. The growth story is not done at Tesla.
Yeah, and Dan, you're kind of going where I was hoping to ask you about. Just beyond China, generally, Dan, do you think maybe we're past the worst quarterly trends now for Tesla, at least for a while? The team at Canaccord, I saw that's what they were arguing to their clients this morning. What do you think?
Yeah, and I think they do great work there, George. Look, I think the worst for now, I think, is behind us. And I think this shows just a change that we're seeing in terms, not just the tone, but even with Musk. I mean, now you're seeing that pilot on the plane, starting with the conference call, now going over to China. And that's why Musk, 10% politician, 90% CEO. That's the key to the stock.
So do you think, to go back, I just want to ask you finally about the other big issue that was the overhang for the stock, and that's the questions about, the Model 2 or mini car or whatever you want to call it. Do you believe, Musk, that it's coming out, I don't know, end of this year, next year or something? What do you think is the real timeline?
Oh, I think, I'll call it a Model 2.5. I think that will be out a year from now. And it went to be, so the point is, it's not a Model 2 in terms of next gen, but it's going to be a sub 30K vehicle, scaled down Model 3 with enhanced software. That's what they needed. That was music to the ears of the bulls. And that's why this week it's been a nightmare on Elm Street for the bears.
All right. I guess it has. Thanks so much. Good to see you, Dan.
You.
We're just getting started here on Market Domination. Coming up, the latest episode of our video series next. Our Kiko Fujita takes a trip to Firefly Aerospace's ranch to see the future of rocket manufacturing. Plus, Paramount shares are rising amid reports the company may oust CEO Bob Bakish ahead of the latest earnings report. We're going to keep you updated on any news from the media giant and break those numbers after the closing bell. Plus, later in the hour, it's the newest edition of our series, Goodbye or Goodbye. We'll get insight on 2 Magnificent 7 stocks to help you make the best choices for your portfolio. Stay tuned, more Market Domination after this. The US Treasury unexpectedly lifting its estimate for quarterly federal borrowing. It's looking to borrow $243 billion in the current quarter. That is up from a previous estimate earlier in the year. The Treasury citing weaker cash receipts. And for the July to September quarter, the Treasury said it expects to borrow a net $847 billion. So the upside of all of this, when the Treasury borrows, it borrows by selling debt. And so the upside to this is if you have more supply coming to market, you could potentially see prices down, yields higher, which is obviously a point of sensitivity here. So we've seen stocks, they're not down much, but a little bit of a leg lower. On
Yeah,
this.
you did see some reaction. We're looking at headlines here. It looks like stocks did get up some gains after that hit. Yields, it looks like, bounced off their lows. So some reaction.
Yeah, some reaction. And it looks like not only was it an increase in the borrowing plans, but it's also higher than most banks on the street were looking for. Just as one example, JP Morgan was looking for $227 billion, and then this $243 billion is obviously higher than that had been anticipated.
We can ask our next guest about it.
Let's
see what
do
he
it.
thinks. Yeah.
Okay. All right, let's talk about the big picture. Stocks on Wall Street mixed, kicking off a big week filled with Federal Reserve rate decision, the monthly jobs report, and, a lot of earnings from more magnificent 7 tech heavyweights. Joining us now to break down what to expect from all of this action-packed week is Dennis DeBuscher, 22V Research President. Dennis, it's good to see you. It's been a little while, so great to have you here and to get your perspective. We just heard about that Treasury announcement here, sort of just already adding to concerns about a higher for longer rate regime here, and that percolating through the Treasury market as well. What's your reaction to that? And do you think that we are higher for longer here? And what does that even mean?
Yeah, I mean, for sure, I do think we're higher for longer. And I think the definition of that would be the Fed keeping the federal funds rate around current levels until they're comfortable that inflation gets, I guess, like a better term, under control or in line with their targets, which around 2.7% on core for this year, and then closer to 2.4, 2.1% next year. To your point on the auctions, or better yet, the amount of funding that is required, it keeps creeping higher, which means it's even more critical that you do see inflation come under control. Because if that doesn't happen, then supply will be harder to absorb by the private sector. You have a higher implied deficit, certainly with higher nominal interest rates. Inflation only would add to that, so meaning pushing up interest rates. So yeah, it's really important that inflation gets under control. I'm actually a little bit surprised since the CPI report that 10-year yields aren't higher. So that is a bit surprising. Maybe there's a better inflation, meaning more dovish inflation to come, but that is a bit surprising to us.
And Dennis, when you say bringing inflation under control, clearly we saw a lot of progress in that fight. Now we kind of stalled here. What do you think does get us, to that last mile here, Dennis, to Jay Powell's target? Do you have to see the economy meaningfully weaken, Dennis? Does it mean unemployment has to ramp? What gets us there?
Yeah, there's 3 main things: wages, wages, and wages. Like when it comes down to inflation and your forecast for core services, which is what we're all kind of trying to figure out where and how high that's going to be in the future, wage growth is critical. And then to your point, will wage growth get to like closer to 3.5% from, say, the current 4, just by normal labor market loosening, quits rates coming down, just less hiring, or will you need a much higher unemployment rate? That's the critical question. So far, wage growth has slowly come down, but it's stalled. And it's stalled in a way that makes people concerned that inflation will be too high. The Fed would eventually have to tighten financial conditions again. The unemployment rate moves higher. So I think you need some combination, or our call is that you need some combination of like 2 to 2.5% economic growth. I mean, maybe a little bit weaker. And then you'll be comfortable that wage growth will come down in a way that the Fed can be comfortable with, meaning we don't need a much higher unemployment rate. If we stay with economic demand that's like well above 2.5, and the initial launch here into 2Q is a pretty strong one, then tighter financial conditions could be needed, and that would probably be associated eventually with a higher unemployment rate.
Dennis, at the same time that wages perhaps need to come down or stabilize at least, we've had goods inflation that has been ticking up again. There was a chart that Torsten Slok of Apollo shared today looking at manufacturing PMI prices paid that showed a coming potential rebound in that goods inflation. So this then makes the Fed's job even more difficult. right? Because as we've seen in the past, they don't necessarily have a great lever to pull when it comes to this type of inflation, do they?
They don't, but I think the good news there is that the goods inflation you've seen is going to be very difficult to extrapolate, right? So on a 3-month moving basis, core goods prices were down like negative 2.3% in December. They ramped up to plus roughly 2.8% exiting 1Q. A lot of it was like consumer electronics driven. There was some kind of finance pricing in there that you want to get into the weeds too. It's stuff that I wouldn't extrapolate. You could be pretty comfortable that goods are going to come back down a little bit, but probably not enough to offset wage growth. So I'm not so worried about goods prices staying around current levels. You'll probably see them come in a little bit, but not enough, to your point, not enough to offset core services inflation if wages don't come down more. I mean, it's very simple. If wages don't come down more, you can, again, in line with what the Fed needs, call it roughly 3.5% over time, then you can rest assured that rates are going to be higher for longer, roughly around current levels, with some threat of an increase. And that's the world we'll live in until, the labor market has loosened comfortably.
And Dennis, so we're talking Fed. Let's switch gears and talk earnings as well, because we got some big names on tap this week. Got Amazon, got Apple. Just interested, Dennis, what you've learned so far this earnings season. What have been your big takeaways? And have you adjusted where you want to be invested as a result?
I haven't really adjusted where you want to be. I mean, 45% of the index as of this morning had reported. 80% of companies are beating. That's well higher than normal. I guess one of the positives of higher inflation is stronger earnings growth. So if you have relatively stable 10-year yields, and that's what we have now, relatively stable and positive earnings growth, it's very difficult to be negative on the market. I think one of the main takeaways, if I had to put it on something, is that it's not all just big tech. You are seeing some broadening out and improvement in earnings, financials and banks in particular. I mean, normally when we've seen these increases in tens from the CPI report, banks and financials have come under intense pressure. That didn't happen this time. There were some big ones, that we saw, but the regional bank index is acting much better than you would have thought, given the increase in 10-year yields, because earnings have been more stable. Even REIT sentiment for earnings has improved pretty nicely. So there is a broadening out and improvement in earnings. Theoretically, that should be good for the quote unquote average stock relative to the Mag 7. But it all for naught if we don't get inflation under control and 10-year yields are just going to keep on driving higher, because then we can reasonably assume that earnings growth will come down if 10s go up a lot.
All right, we'll see what Jay Powell says and does on Wednesday. Dennis, thanks so much for joining the show. Appreciate it.
Thank you.
And coming up, it's latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at two AI players in big tech, both of which recently delivered first quarter results. Joining me now, Melissa Otto, head of TMT research at Visible Alpha. Thanks so much for being here.
Thanks for having me.
So let's get to the stock you're more bullish on of those that just delivered their numbers, and that is Microsoft. And the shares already have done quite well over the past year, and in reaction to those numbers, of course. So we got the stock chart. So let's run through why you are more bullish on this name. Let's start with Azure and the cloud demand that Microsoft is seeing. So what did we learn in the quarter that gave you reasons for optimism?
It's been a very dynamic earnings season. Based on the Visible Alpha consensus coming into the quarter and coming out of the quarter for Microsoft, we really saw the company either meeting or beating expectations on numerous fronts in the quarter, and then providing guidance that was, particularly for the Azure business, ahead of expectations. The Azure business, based on management commentary, is essentially seeing demand that's exceeding where the current capacity is, and they're taking share. So it's, I would say, net, that's a pretty good position to be in this environment.
Melissa, we are going to pause because we're having a little technical difficulty with your mic, but we're going to get you all set, and we're going to take a break and come right back. Stick with us. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at two AI players in big tech, both of which recently delivered their quarterly results. And joining me now is Melissa Otto, head of TMT research at Visible Alpha. Thanks for being here. We're all set now. So let's talk about the stock that you are more bullish on in this universe, first of all, and that is Microsoft. Microsoft, of course, has risen over over the past year. It rose in response to its results as well. And you like it in part because of the demand that we are seeing for the cloud business, for Azure. So talk me through that.
Thanks for having me on, Julie. It's great to be here. It's been an incredibly exciting, I would say an incredibly exciting earnings season. Microsoft, based on Visible Alpha consensus, delivered a quarter either in line with expectations or on many counts, I would say they beat expectations based on Visible Alpha consensus. And then looking ahead to their guidance beat expectations on multiple counts based on Visible Alpha's consensus. You know, as we look into some of the details around that data, what has been really interesting is that company management has said demand for the Azure business has been exceeding capacity and that the company continues to take share in the space. That's a great place to be in this current environment. Based on Visible Alpha consensus for the Azure business, that business was actually expected to generate about $94 billion in revenue in 2025. Now it's expected to generate 96 billion. So just in, kind of pre-quarter, going post-quarter, just in a matter of a couple of days, the sentiment around that business is already ticking up, suggesting that there is some optimism building into those numbers and those fundamentals. And I think, as we think about the risks to that business, looking around what could actually drive demand. What is driving demand? It's all about AI.
Right. Well, let me interrupt you there because we've got the strong Azure outlook, which you talked a little bit about as well. But I do want to talk about how AI is reading into all of this. Because what's interesting about Microsoft is there's demand for Azure services because of other companies training their AI, and then there are things that Microsoft is doing, offering its own AI services. So it's sort of benefiting on two different fronts.
Indeed. I think the crux of the Azure business and demand for that is really about demand for public cloud and the solutions that are around that will enable the AI to actually happen within organizations and institutions, enterprises. One of the things that CEO Nadella called out in the earnings call was talking about the cultural transformation that companies have to make to get through this. And this is really one of the potential risks, is that cultural transition may actually take longer than companies are anticipating as they embed those methodologies, train people, and really think about how generative AI is going to be embedded in their workflows.
Gotcha. So maybe it's going to be a little bit more slow than anticipated. So overall, you are bullish on Microsoft, but with that caveat that maybe that cultural transformation will be a little bit slower. So let's get to the stock that you are more bearish on in this universe, and that is Meta. Now, Meta, like Microsoft, has done well over the past year. In fact, has outperformed Microsoft over the past year. But in reaction to the earnings, of course, we saw a decline. A lot of that has to do with what they predicted on expenses. So that's something that obviously caught your attention.
Indeed, in line with this exciting earnings season, Meta, they delivered a quarter that was broadly in line with Visible Alpha consensus. Looking ahead to guidance, it was mixed. On the top line, they delivered in-line guidance, but on the expense line, based on Visible Alpha consensus, it was higher.
Yeah.
And I think that combined with commentary from Mark Zuckerberg saying that this is going to continue for a while, it suggested that the year of efficiency is potentially over.
Right.
And so as we look at Visible Alpha consensus numbers for the expense line, right now, that the expenses are expected to be $96 billion this year, but to jump to $119 billion by 2026 based on Visible Alpha consensus. What's interesting about that $119 billion number is it ranges from $110 to $126 billion. So it means there's a $16 billion question mark out there about what Meta can actually do with their expense line. And so I think that's something we're watching very closely.
Yeah, investors want that predictability, right? And it's AI that's about this. Draw the contrast for me between a Meta. Microsoft's spending more on AI too. Alphabet is definitely spending more on AI. Why is it a bad thing for Meta? Is it because of that unpredictability?
I think it's this, in terms of expectations, the expenses have ramped faster than expected,
Gotcha.
number one. And then you have this huge range in terms of where the expenses may actually land. I mean, I think going over the next couple of quarters, what would be ideal is to get much more visibility into what those expenses will actually look like rather than some nebulous comments from senior management. I think we would like to know, okay, they are going to be higher for longer, but actually how much higher? When does the rubber hit the road in terms of what those numbers will actually look like? And what can we anticipate so that it will be much clearer in terms of what that range should actually be?
Right. Right. All of that makes sense, wanting more. But as you said, you anticipate total cost to rise. On the flip side, maybe it'll come in on the lower end of that. I mean, or maybe it'll be more clear what the ROI is from this money that they're spending.
Indeed. I mean, we would like to see, okay, they're spending this money. What do shareholders get in return for it? I think there are some open questions around that.
Yeah, definitely so. So more bearish on Meta, more bullish on Microsoft. I'm just going to run through and summarize what you are telling folks here. So you're more bullish on Microsoft. It delivered a very solid quarter with the Azure business. The outlook for that business looks strong. On the other side, you are more bearish on Meta because of that big increase in expenses and the uncertainty around what exactly they're going to be. Thank you so much for being here, Melissa. Appreciate it. And thank you for watching Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
And now for our top analyst call of the day. Apple receiving an upgrade from Bernstein to outperform from market perform. The analyst behind that call urges investors to be like Buffett and buy shares while they are at a lower cost. Apple shares are soaring today. So interesting, Julie, of course, this is a very well-known Apple analyst, which is part of the story here. This is Bernstein's Tony Sacconaghi, and when Tony makes a big change like this, it does get attention. He does go to the equivalent of a buy. His price target, by the way, stayed the same. It was $195. And in general, his point seems to be, listen, we know Apple's been under pressure for a few different reasons. The stock is in a funk. It's lagging the market. It's lagging big tech peers. And the bad news he's suggesting is priced in and likes the look of valuation at these levels.
Yeah, a couple of different things I took away from his note. One, he says the China story is misunderstood. It's not a structural problem. It's a cyclical problem or seasonal problem. He says that the sales should improve there. Secondly, he said the iPhone 16 cycle could be strong because he expects some AI functionality in the next version of the iPhone, which I thought was interesting. And thirdly, when you talked about a valuation, I thought it was interesting. He views Apple as an iconic consumer brand, not necessarily as a tech hardware company. And as such, the peers, when he's looking at valuation, he actually put it against consumer brands. And he says by that measure, it's not actually necessarily overvalued.
Well, I think that's what he means when he's saying, be like Buffett. There is this thesis out there that some people say you should really think of Apple as almost a consumer staple company. Right. You buy it and you buy it over and over again. That seems to be part of his thesis as well.
One quick caveat, because and we talked about this before the show. So Tony Sacconaghi has been at a market perform that's been his rating for Apple since 2018. He downgraded it from outperform to market perform on February 2nd of that year. Since then, the stock's rallied some 335%. So I guess if you were market perform, if you were holding the stock, you were fine, but you weren't adding to it as it was having pretty big upside.
Well, let's get a No Smart take on all things Apple, because all eyes will be on the iPhone maker when it reports results for its fiscal second quarter this Thursday. The stock has had a lackluster start to the year, down more than about 10% in 2024. Here with what to watch for the iPhone maker's results, Ben Beharin, Crave Strategy CEO and principal analyst. Ben, it is great to have you on the show. So Apple does report Thursday. Ben, walk me through what are the key metrics, Ben, you're going to be focused on when that print hits the tape?
Yeah, I think the big one is just seeing where we're at in terms of iPhone sales. Most estimates have come in expecting it to be relatively flat, so maybe slightly up, maybe slightly down, but not a huge drastic change. So I think that's a positive. There's certainly been some areas of the world. It looks like some numbers came in that in Europe they grew And in the US, they actually grew slightly. Obviously, we've talked about before, they're down in China. So on top of just where iPhone is, I think that's where we're going to look at where we're at in the cycle, and then any commentary around that. How are things looking in China? Are we seeing a recovery in high ASP parts of the market? I think those are going to be some of the big questions. One of the things a lot of people will be looking at is there any commentary on mix shift? The last couple of years with iPhones, the buyers have moved more to the high end of the market, buying things like Pro and Pro Max. I think they're going to want to see if that's continuing just to get a gauge of ASPs. But a lot of that stuff hopefully comes out in commentary. But I think, again, all eyes on iPhone and just sort of seeing where we're at in this cycle, and expectations are probably relatively flat.
When you talk about something like the services business as well, Ben, is that just sort of chugging along steady as she goes there? That's not really where the swing is coming from at Apple anymore?
Yeah, I think there's a number of things in terms of the growth business, right? Services, in my opinion, underscores the stickiness of the ecosystem, right? If you listen to management, they talk a lot about the growing installed base. Apple does not lose a lot of customers. They have a very sticky and they retain those customers. And then those customers spend money in the ecosystem, a la services. So I think that's a stat that just continues to show engagement. We expect that, again, to continue to have some parts of growth. We don't really know how much cyclicality there is in services because, for a while it was on a growth, then it slowed. So I think that'll be a big question. But a lot of the numbers that they share around what their customers are doing, adding new subscriptions, spending money in the App Store, engaging in those subscription services, buying more, that's really just showing the health of the ecosystem. Because then as Apple grows new customers, because every quarter they talk about growing their installed base, those customers don't leave and they spend more money, which creates kind of the sum of the whole part story for Apple.
And Ben, part of the reason that the stock's been under pressure is because there's concern by some investors about the company's sort of Gen AI strategy. What do you think, Ben, that Gen AI strategy is? And do you think we get any more new insight into it on this earnings call?
Yeah, probably not on this earnings call. Honestly, I think the big expectations at this point is around their worldwide developer event. A big part of this, and I do think people sometimes underappreciate what Apple's doing here in silicon and Apple Silicon. But yeah, as anybody who covers the semiconductor industry relative to AI knows, that silicon semiconductors and their advancements in compute is the fundamental force that's driving increases in AI capabilities. So on these devices, Apple's very well positioned with that, with their Apple Silicon, their Apple Neural Engine, and some of those things that are yet to be fully tapped into for AI. Now, the big question is, what do they do for developers? What software tools do they do? And how do they unlock the software potential of that silicon in order to move and let more developers take advantage of that, and then bring value to customers in whatever way Apple sees fit, right? We still don't know what the major use cases are for these things. We hope they're helpful, and I think we'll wait probably to WWDC to see what that looks like from Apple's standpoint.
Right, I was going to say, unfortunately, we're not going to find out the answer to that question likely this week when they report earnings. But also out with earnings this week will be Amazon, and I'm curious what you're watching for there, especially after we saw the big Azure growth at Microsoft. It'll be interesting to see what AWS looks like.
Yeah, I think that's the same. Everybody's going to be looking at cloud growth for AWS. Right now, it's super trendy to talk about CapEx. Everybody wants to see what the hyperscalers are spending in terms of new infrastructure, buying AI servers, creating these AI factories, as NVIDIA likes to call them. And I think that's really going to be a big spotlight being looked at where Amazon's growth is in terms of AWS. I think it's just probably predictable that it's going to be healthy, somewhat double digit. Where are they going? Where are they guiding? And what CapEx are they investing in? I think it's what people are going to look at. But I think expectations are that that's healthy. AWS is going to be strong, just like the other hyperscalers. But again, it's a very expensive environment to keep investing in that AI and then start to monetize AI in that through, in Amazon's case, things like e-commerce and a host of other services that they provide to startup developers and enterprises as a part of AWS.
Hey, Ben, you think we could see Amazon add a dividend here? Alphabet delivered on that, right? Investors sure seem to appreciate it.
Yeah, I think that's been a lot of talk. I've seen a bunch of speculation on this buy and the sell side around that. People want to see them move more closer and start to do a dividend. I don't know if it's this quarter, really hard to predict, but it does feel like that's inevitable. At the same time, if you look at between Google's kind of long-term prospects and just the behemoth that is Amazon. Amazon's still a highly desirable stock. I don't think they need a ton more incentives to jump into that because revenue is going to continue to be strong. But I think it's something that's on a lot of investors' mind. And obviously, if they do that, I think there'll be a lot of positivity to that as well.
Ben, good to see you. Thanks so much for joining us to chat about what to expect from these tech heavyweights. Appreciate it.
Anytime. Thanks for having me.
Up next, with earnings season underway, we're taking a look at the healthcare space in our investor playbook. Stay tuned. Healthcare is one of the largest sectors in the S&P 500, but it has underperformed overall markets this year. As the first quarter earnings season gets underway, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. To discuss the outlook for the industry, we're joined by Megan Fitzgerald, Grey Ghost Advisors private equity investor, and Brian Tanquilut, Jefferies Healthcare Services equity research analyst. Thank you both so much for being here, Meg. Friend of the show, good to see you as always. And Brian, welcome. Meg, let's start with you because we have indeed seen healthcare underperform. And obviously, healthcare is very complicated. There are a lot of different subsectors right now. There's been a lot of sort of fireworks around what's happening in pharma, in the GLP-1s. What are we going to see earnings-wise? Are we going to see companies deliver on some of that promise?
Yeah, I think we are. I think healthcare, it's material to the Fortune 500. There's still a lot of long and important tailwinds around demographics, innovation. And this tends to be a place that does well during downturns and during elections. So I'm pretty bullish that healthcare will get out of being a laggard and move to the front. I do believe you're going to see strong earnings this week from Lilly and Novo and those that have a GLP portfolio. Quite frankly, I think it's an easy beat. I think the one that everyone's more interested in to see how Pfizer unfolds with the Seagen acquisition and integration, as well as some of their cost-cutting initiatives. Last week, Bristol Myers Squibb said that they were going through a $1.5 billion cost-cutting. So I think many in pharma are getting down to fighting weight, optimizing their portfolios. And quite frankly, they have about $1 trillion worth of dry powder. So I think the meeting at ASCO in 30 days will be very interesting to see if there's some acquisitions.
Brian, same question to you. Talk about healthcare, obviously big sector, lots of verticals and subsectors, but give us your big picture take, Brian. What are you expecting with earnings?
Hey, Josh, thank you. So yeah, I think the first thing I would say is that what we've seen so far is that there is or has been a rise in broader healthcare utilization trends. So kind of taking back to Megan's comment about demographics being a tailwind, we're starting to see that show up in the earnings results of the managed care companies, the healthcare insurance guys. And that has translated into some underperformance for names like United Health and Elevance and Humana, right, over the last 6 months. Now, the flip side of that, though, is that we are seeing the corresponding strength in volumes from hospitals, labs, imaging companies, and basically all these healthcare providers. So what we're seeing is that, when I look at my coverage universe of healthcare services stocks, we've seen some strength year to date in some of these big names.
Brian, I'm curious if there is any concern, if we're starting to see a little bit of weakness at the edges of consumer spending, if we will see any kind of decrease in elective surgeries or other kinds of procedures, and if that's going to pressure the companies that you cover.
You know what's interesting, Julie, is we are actually seeing strength in elective procedures, primarily in the Medicare Advantage population or the seniors, right? So if you think about it, government-run insurance for seniors, there's very little out-of-pocket there. So it's not as sensitive to broader economic trends. And because the aging demographic, rather the aging population trend is there now, where if you think about the oldest baby boomer, born in 1946, is now 78 years old, we've seen the senior population get to that point where they're actually using more healthcare, they're getting more sickly. So without a big out-of-pocket component, the macro side of things is not impacting demand and utilization. Now, where we are seeing the impact of macro, though, is on the consumer healthcare side. If you're thinking of the drugstore, right? I mean, when you look at what CVS and Walgreens have said, we are seeing some weakness on the front end of the store as a result of pressures on the consumer. But in the true healthcare utilization environment, like real healthcare services, that has actually been on the uptrend, if not, really been strong the last few months.
Megan, back over to you. Another big trend we've seen in this space, Megan, is M&A. I'm just curious whether you expect that to continue, and if so, are there certain sort of verticals or subsectors, Megan, where you would expect to see that activity be more pronounced?
Yeah, I think it's a great question. I think a lot of biotech has slowed down because of the rate environment, but big pharma is very active. Last week, there was $1 billion acquisition. I think big pharma will continue to put money to work. And then, of course, there's been a lot of activity in the private sector and on the VC and PE side. Last week, we saw one of the largest biotech startups ever get off the ground, and that was in AI, $1 billion launch of a new company that was going to try to expedite drug development. So I think the private markets will be very active. I think there'll continue to be a lot of companies divesting things in healthcare that are not core assets. And so I think it should be an interesting year. The only caveat is obviously the rate environment makes it a little bit tricky for some that don't have cash and are looking for financing.
And Brian, as I look at the earnings picks that you have, the picks right now, and I see the likes of BrightSpring and Tenet on the list, what sort of distinguishes the stocks that you like better right now in an environment that you described as sort of broadly positive?
Yeah, so I see that you just have my graphic on of the picks that we have getting into earnings season. So the broader theme really here is utilization. So Tenet Healthcare runs one of the bigger chains of surgery centers, ambulatory surgery centers across the country. So they're benefiting from elective surgeries, specifically in joint replacement. So senior population is growing, and they're getting older. They're getting more joint replacement cases. And doctors would rather do them outpatient than inpatient, moving away from hospitals. So Tenet is a big beneficiary of that. Now, HCA, largest hospital company in the country, has also seen some of that. Behavioral health, Julie, is an area that we are very bullish on. We think that there's a lot of consumer interest in government funding and insurance funding to bolster behavioral health, mental health services and access. So we like Acadia Health for that matter. BrightSpring is actually a play on biotech and specialty drugs. They are one of the largest distributor of specialty pharmaceuticals in the country. So as the pipeline of new drugs comes in, new drug development translates to very good volumes for BrightSpring. And then my last pick there is RadNet. It's a combination of, they're the largest operator of imaging centers in the US, so x-rays, mammograms, ultrasounds. But the flip side of that is they actually are the world's largest imaging company in AI by revenue. So they're benefiting from the use of AI in diagnostic imaging. They have FDA-approved products used here in the US and the UK. So we're very bullish in RadNet here.
Megan, final question to you. I'm just interested to get your take on this, Megan. It's kind of an interesting headline. You saw that Oracle, it's moving its headquarters to Nashville, Megan, to be closer to the healthcare industry. Is that a trend here, Megan? Is Nashville sort of should we think about it as kind of one of the new epicenters of the healthcare industry?
I think it's been the epicenter for 10 years, and a lot of people are figuring it out. It definitely is a hub of innovation. It's where HCA was born. I had invested a long time ago in a company called Navi Health that was bred right out of there. So very tight alignment between providers and payers, and just a smart network of folks. I saw today a chart. Houses are very expensive there. So might be a little late, might have to rent or get a roommate if that's going to be your healthcare place to kind of venture to.
I think Brian's already there. Don't you live in Nashville,
Yeah, I was
Brian?
going to say, Josh, I'm in Nashville, so I've seen it grow. And it to Megan's point, I mean, I think innovation in healthcare services is very strong here, but we've seen it expand beyond just healthcare services. So we're seeing healthcare tech. There's some life sciences companies starting to emerge here in Nashville. So it is really becoming the healthcare hub outside of biotech. So we're pretty excited here on the ground for what it does.
Megan, Brian, it was great to have both of you on the show today. Thanks so much for joining us.
Nice to see you guys.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from Paramount. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start where the major averages ended up. And actually, we recovered some of those losses that happened right around 3 p.m. when we got news about the larger than estimated borrowing plans of the US Treasury. The Dow still managing to go up about 147 points by the end of the session. The S&P 500 finishing higher by about 1/3%, as did the Nasdaq. So all three major averages higher. Not a barn burner kind of a day, but still finishing up. Just want a quick check on trending too, to get one final check on how Tesla did before the end of the day, finishing up by 15% here. So big increase there, obviously, after we had the news of Elon Musk visiting China and getting approval to roll out full self-driving FSD there. SoFi Technologies was our earnings loser of the day, down 10% after that company came out with a forecast that was a little bit below what analysts had been anticipating. So that's what happened on the individual mover front. Some highlights. This check sponsored by Tasty Trade. Now over to Jared for a closer look at the action.
Thank you, Julie. I want to stick with Tesla for 2 seconds here. I'm going to put a 4-day chart on. You're going to see it's up 34%. That is the best 4-day run in about 4 years. You'd have to go back to 2020. So on that note, let's pivot to sectors here. Consumer discretionary, which, by the way, Tesla is one of the biggest members next to Amazon. XLY ended up 2.35%. Following that, we have utilities and real estate. So two defensive sectors, two interest rate sensitive sectors. Those are following. Then we have materials, industrials, and energy to round out the top row. Communication services and financials were the only two sectors in the red. And let's take a look at the Nasdaq 100. And indeed, Alphabet dropping a little bit after its outperformance last week. You can see it's down 3.37%. Meta also in the sector down 2.4%. Microsoft is a tech stock, but it was down 1%, and Apple 2.5% to the green side. That's something we haven't seen a lot of recently. Looking forward to those earnings a little bit later in the week. And here is my leaders board. Now, ARC, that would be disruptive tech, unprofitable tech, 2.38% in the upper left, followed by solar. Then we have gambling, biotech, Korean stocks, emerging markets, small caps. Really interesting mix here, but not really anything taking my eye far and away off the page here. GBTC, that would be my Bitcoin play. That's the biggest loser here. Also looking at regional banks, KRE down 0.8%. Interesting ahead of that Fed meeting that we have Wednesday, but nothing too big jumping out here, Josh.
All right, I'm going to take it here, Jared, because we do have some breaking news here. Paramount CEO Bob Bakish is indeed stepping down. This confirming some reports in recent days that his job was in jeopardy. And as had been expected as well, or had been reported upon, he will be replaced not by a single CEO, but a so-called office of the CEO with heads of the various divisions of the company. Now, in recent days, there were reports that Sherry Redstone and others, members of the board, were not satisfied with Bakish's leadership. Paramount's market cap has really been cut as he has been CEO. But of course, the backdrop for all of this is A, the company's up for sale. It's got several bids on the table. And B, it's just reporting its earnings as well. I'm just seeing those numbers cross too, and it looks like they're missing by a little bit. So we're going to keep going through those numbers. But Josh, just has been sort of an extraordinary time here for Paramount shareholders.
Yeah, you wonder, I mean, as you know, obviously these companies in play, if and when a deal gets done, how this sort of impacts and influences that, because you would now be doing this huge deal at a time when you've had dramatic big changes in the C-suite. So you'll be trying to do a deal that's obviously very sensitive, potentially regulatory hurdles, and at the very same time that you've had these enormous changes in who's actually running this company. So interesting how that kind of could impact and influence the potential deal if and when we hear that one gets actually done.
Yeah, let me just run through the numbers as well, if that's okay, because we just got those Paramount Global numbers too. It looks like revenue coming in at $7.69 billion. The estimate was for $7.74 billion. Adjusted earnings per share from continuing operations, 62 cents. That's better than had been estimated. And if you look at the different divisions here, TV revenue coming in a little light of estimates at $5.23 billion. Direct-to-consumer revenue, $1.88 billion, roughly in line. And filmed entertainment revenue, a little bit better than estimated, at $605 million. So a little bit of a mixed quarter there. I don't see any kind of forecast as of yet here from the company. But you see the shares moving higher in the first blush read here. But, you know, the big question is, like, I don't even know how one trades this thing without knowing what a sale is going to look like.
Yeah, and we did see reports that, you know, there was sort of the Skydance offer did get there was a sweetener there, and so does that kind of move the needle? Of course, you know, there's others, you know, we're waiting to hear Apollo, parent company of this network, and Sony, so there's a lot in play. The numbers, to your point, Julie, now we're actually kind of drifting here, but we're still up about 1% in the after hours. I mean, all of it sort of takes a backseat to the drama of whether, you know, this company even remains an independent company.
Right, and if it remains an independent company as itself, or if it gets broken into different parts. Also seeing a headline here, the Paramount Plus subscribers rising to 71 million, which looks to be a little bit better than had been estimated. So some of these numbers actually looking pretty decent here, even as there is this drama that is unfolding around the company. And to your point, the shares are bouncing around as investors try to figure out what to make of all of this.
Yeah, well, luckily we have a very smart analyst coming up to help us walk through it.
We do, because it's a complicated situation.
All right, stocks inching higher to start a busy week for Wall Street. Josh Schaefer is here with the takeaways from the trading day. Joshua.
Yeah, Josh, I'm not going to sugarcoat it. It wasn't the most exciting Monday we have had in markets here, right? But I think sort of zooming out, maybe one of the reasons it wasn't the most exciting Monday is because we do have a big week ahead of us with a lot of catalysts, and I think that's sort of taking the forefront to start the week here. Specifically, I was sort of struck reading through various amounts of Wall Street research today and the different macro strategists that we follow, all talking about Treasury yields and all talking about the rise we've seen in the 10-year and sort of the 10-year being the key to the direction. I think that's why we saw a little bit of a sell-off later in the day. I shouldn't say sell-off, a little bit of a drop in where we were on the day, as there were maybe concerns that we might have rising yields perhaps to open the market tomorrow. But I think overall, that seems to be where a large part of the focus is right now, not necessarily on earnings. There are not a lot of people coming out and saying positive earnings from Amazon and Apple can give us reassurances that the rally is going to continue. That doesn't really seem to be where the broader market narrative is at right now. It seems to be a lot of concern about what Jay Powell is going to say on Wednesday and what that does to Treasury yields. Mike Wilson over at Morgan Stanley noting that he thinks unless Powell is dovish and perhaps aggressively dovish, we're probably not going to see the 10-year tick down any lower from where it is right now. And where it is right now, up above 4.6%, a lot of strategists just don't like stocks that aren't in sort of that large cap sector, and it sort of limits where you can go.
I mean, it's interesting too because, you know, that they're focused on that and not on earnings, because the reactions to earnings have not been fantastic. Or companies have been beating.
Yeah.
But stocks have not necessarily been performing very well in reaction, as we've talked about.
Yeah, and Wilson pointed out in his note that the earnings surprise, the average earnings surprise for S&P 500 companies this quarter is at 9%, which would be the best since 2021. But the reaction he described as, quote, muted. Stocks really haven't done that well. And I don't know, Julie, maybe yields is playing a part in that, or just the overall, we'll call it macro uncertainty, which is what we like to say, right?
Vibe shift.
When we don't know why what seems like a good read isn't moving a stock that much, you sort of fall back on that. But maybe that is playing a little bit of a role right now. Okay, earnings are decent for this quarter, but where are things headed with rates? Are we going to get any level of a cut this year? Or are we perhaps shifting somewhere to maybe they'll start talking about a hike? I think people are just in a little bit of a teeter-tottery place with it, and that makes it sort of hard to make a decision on earnings.
Right.
Unless you're Tesla, right?
Yeah, unless you're Tesla, which was the big stock story of the day. Not an earnings story, obviously, or at least not directly
Not
immediately.
today, yes.
But you put in a call to our friend Ihor at S3 to figure out, was part of the move that we saw recently, which is a big upward move in the shares, was it a short squeeze?
And Eeyore said it wasn't necessarily a short squeeze. That's not how he would define what's been happening in Tesla shares. But we have seen shorts lose a massive amount of money over the last week. So shorts have lost over $5 billion in the past 5 days as this stock has gone up, as you were just seeing on your screen, over 30% since Tesla did report earnings. We should note, though, it's been an interesting ride for Tesla. Of course, this stock, people are very bearish on the stock going into earnings. Shorts are still up several $billion on their short positions for Tesla on the year. So that gives you a little bit of point of reference of how bad the stock has been doing. And to me, guys, the most interesting thing that S3 pointed out, 2 million new open short positions in the last week as the stock has been going up. To me, that sort of speaks to where the Tesla story is at right now, right? You're either bought into the AI future and sort of the lofty goals, or you're still sitting and looking at the fundamentals, as plenty of analysts we've spoken with in the last week are, and saying the story just isn't there. And I think it's interesting that even as the stock has sort of fought back here and had a nice week, there are still people coming in and saying, I'm not buying this story.
Yeah, well, it was interesting, and we put this question to Dan Ives about how the team at Canaccord, and they do really good work over there. They were kind of posing that question, and maybe are we through the worst, at least for a little while here, is something they were putting. Now, they are bulls, but it was interesting to just kind of put that out there.
Yeah. Even how Dan has flipped in the last month, our friend Dan Ives over at Wedbush. I mean, he called it a turning point at the beginning of the month, right? And now we're sort of a month.
Turning to bad.
Yeah.
And now he's back to good.
Now he's like, they kind of made out okay. So I guess we'll wait and see, and so will those short investors, for sure.
All right, thank you, Josh. Appreciate it. We move on. A key event on the calendar this week, of course, Wednesday's big Fed decision and news conference from Fed Chair Jerome Powell. While no move on rates is expected anymore, investors will be listening closely to how Powell addresses questions about the shifting stance on rate cuts. Joining us now is former Atlanta Federal Reserve President Dennis Lockhart. Dennis, it is always good to have you on the show. So, maybe we'll start there, Dennis. What do you expect to hear on Wednesday? What do you think the Fed says and does, Dennis?
Well, in the Powell press conference, I think he almost has to be somewhat non-committal because the question of rate cuts and the timing of rate cuts and even the question of a rate hike are all in the air at the moment. They're coming off a quarter of sideways inflation data, so they really don't have a good sense of how the inflation picture or the disinflation picture is going to play out. So I think they have to keep their options open. So this is likely to be a non-committal meeting.
Are you in the camp that thinks there's even a possibility that we could see another interest rate increase? And if not a hike, then other ways, maybe, some quantitative tightening or some other methods on the edges to sort of tighten things here?
I don't think a rate increase is the base case, but I also do not think its probability is zero. Just depends a little bit on how the rest of the year plays out. So I don't think Powell will encourage the view that there's going to be a rate increase. However, he will probably also not. He won't totally take it off the table, and he'll repeat what he said before, and that is, if it's necessary, the committee will not hesitate to act in that respect. So this is a time in which it's unclear whether the first quarter inflation was a stalling out or just a bump in the road. And I think he just simply cannot be definitive on any particular path of policy.
Dennis, I asked this question earlier in the show to another guest, but I want to get your take on it as well. Inflation, we did see great progress, Dennis, and kind of stalled out here. To get back to Jay Powell's target, Dennis, what needs to happen? Does unemployment need to ramp?
Well, I think if you're going to see a slowing of the economy, a slowing of demand, a slowing of effectively the top line of the economy, you're probably going to see a rise in the U3 unemployment rate to some extent. I don't think the committee is encouraging that or wants to see it rise well above where we are today. They still would like to see this soft landing scenario play out. But yes, I think employment is something that probably has to move a bit if they're going to blunt demand enough to get the inflation rate resumed its path to 2%.
And Dennis, I'm curious to get your take on why the tightening that has happened thus far is not having the intended effect. And we're talking about a potential slowing of the economy and unemployment rate going up, but it hasn't happened already. So why would it now happen?
Yes, it's quite interesting that even though the committee has stated in the past their belief that we're in restrictive territory, and in restrictive territory we should be seeing the effect of the high interest rate setting, In fact, the resilience of the economy has motored on really strongly, and it appears that certain sectors, at least, are somewhat impervious to the high interest rates. And there could be a lot of reasons for that. You know, we've all read about people who are locked into low-rate mortgages, and therefore they're not really hit or influenced by the higher rates. People perhaps who are affluent enough not to have to use their credit cards, that kind of thing. There probably are multiple reasons why there's some imperviousness to high interest rates, but so far the economy has tolerated this rate setting extremely easily, it seems to me.
Dennis, it is always great to have you on the show. Thanks so much.
Thank you.
On the other side, we'll be joined by an analyst to take a deeper dive into the latest from Paramount as they are moving on with a new leadership team over there. Stay tuned. More market domination overtime coming up. Let's get you up to speed on the action from today's trade, sponsored by Tasty Trade. Modest gains today on Wall Street. Listen, we know there's a lot of news coming this week. We got Amazon and Apple earnings on deck. First quarter earnings, by the way, Julie, now on track to increase 4.7% from a year ago, compared with a preseason estimate of 3.8%. That's according to Bloomberg. We also have Fed Day on Wednesday. What will Jay Powell do and say? And of course, on top of that, big April jobs report on Friday. So maybe not too surprising. No big moves to the big indexes here. The Dow's up about 0.4%, S&P 500 up about 0.3%, Nasdaq up about 0.3%.
And Paramount announcing a leadership change as CEO Bob Bakish steps down. He'll be replaced by a troika of executives. The news comes as the company posts a beat on earnings, reporting 62 cents in adjusted earnings per share versus estimates of 36 cents. While revenue for the first quarter did miss Wall Street expectations, the stock up around 2%. It's been bouncing around in after-hours trading. Joining us now to discuss Third Bridge Group sector analyst Jamie Lumley. Jamie, there's a lot to sift through here. I'm going to start with the leadership change here as Bakish is out, and now there's this sort of committee of different heads of divisions forming the office of the CEO. Putting aside everything else going on with the company, if we can, is this the right move for Paramount?
Thanks for having me. And really, there is so much to pay attention to. It's hard to really focus on one piece without looking at the others. And definitely the timing around the CEO transition is certainly interesting, as of course raises the question, is this what is best to make sure that M&A will be completed, as it is very evident that the Redstone family is looking to cash out and make a deal. And this could potentially weigh on whether or not we will see a deal be made by this Friday when those 30-day exclusivity period with Skydance comes to a close. But just looking at the business fundamentals, M&A aside, Paramount has been facing a variety of challenges over the last few years. It's trying to find the best way to stabilize its traditional linear TV business while also make the pivot to streaming. And there are definitely some positive signs in streaming. If we look at those operating results, it's trimming losses for Paramount Plus. It's continuing to see subscriber growth. There are definitely some things going in the right direction there. But whoever does ultimately get in that CEO seat, as you mentioned, the 3 executives are currently there now, it is a tough job, but they still do need to figure out what the transition looks like and how can Paramount do that fast enough before they really start to see further pressure on their underlying traditional media business.
I'm interested, Jamie, though, this deal between Paramount and Skydance, as you noted, exclusive talks until May 3rd. I mean, bottom line, Jamie, as you look at it, do you think that deal does get done?
At this point, it is really tough to say, because on the one hand, there are definitely some advantages to controlling voting shareholders right now. But at the same time, there's been a lot of pushback from regular shareholders here too, and looking at ways in which this might not be the deal which they envision for Paramount. Because also, if we look at this, if Skydance is able to ultimately get this through, it does definitely create a powerhouse in terms of studio capabilities. It doesn't fully address some of the challenges facing the linear parts of that business, though, and a lot of those challenges will persist. And while certainly the balance sheet might be in a more stable position, there's not necessarily a clear plan as to what the best way is to address those underlying issues. So we could see a deal, but there definitely does still seem to be a lot of discussion going on at the 11th hour here.
And Jamie, what do you think is the best outcome for shareholders?
So what we've been hearing at Third Bridge is, at the end of the day, for Paramount, the most likely move is to break up this business. There are a lot of very valuable assets here. If we look at the history of the Paramount studio, the IP that they have, the capabilities they have to churn out some of the biggest movies of the last few years, there's definitely a lot which that business can offer. But at the same time, there are other parts which, might not necessarily make the most sense to hold on to going forward. Right now, let's not forget, another moving piece right now is the fact that Paramount is engaging in carriage negotiations with Charter. And we might see a very fundamentally different picture for what's going on with those cable assets going forward. And there might be a future where Paramount should try to really just not rely as much on some of those tier 2 cable properties, which might not be able to gain distribution or ad dollars going forward. So what we're hearing is that we could see a bit more of a breaking up of this company to really realize the true potential of different parts of that business. The question, of course, though, is who's going to manage the more challenging parts of that media portfolio, which are not necessarily what everyone wants to pick up right now.
And Jamie, get you out on this. This is all against the backdrop of a much tougher regulatory environment. I'm just curious, if a deal got done, what kind of regulatory risks do you think, Jamie, there'd be here?
Yeah, so the big regulatory piece is all focused around what it really means to own and operate a network. If we look at CBS, it certainly has a lot of value to it. There are a lot of interesting aspects there from the sports rights that includes, but there are certain companies which would not be able to run that business. If we were to think about, Comcast hasn't been in the picture here, but what it would mean for them to operate NBC and CBS, that's something which regulators would not most likely take a positive view on. So looking at ultimate ownership of CBS is something which would definitely bring some regulatory scrutiny. And then also just the other piece about overall concentration in media assets. I mean, if we think about the landscape today, there's certainly been a number of cases where deals have been stalled or delayed in the media space. So just thinking about what that suitor is, what scale they already have, is something which could factor into this as well.
Jamie, good to see you. Thank you so much for helping us try to unravel this complicated situation.
Thank you.
Coming up, we're going to tell you everything you need to watch for Tuesday to best kickstart your trading day. Stay tuned. More market domination overtime on the other side.
Time now for What to Watch Tuesday, April 30th. Starting out on the earnings front, another big week of earnings ahead with Amazon, AMD, and 3M from the tech sector reporting tomorrow, among others. Wall Street will keep a close eye on Amazon announcing first quarter results for 2024 after the bell. Earnings expected to come in at $1.23 per share on revenue of $142.59 billion.
And looking at a few more earnings, we'll get reporting from some food and beverage companies, including Coca-Cola, Starbucks, and Mondelez. Mondelez first quarter earnings will come after the bell as well. Analysts expect a steady surge in cocoa prices to be a focus on tomorrow's earnings call.
And finally, taking a look at the economy, new consumer confidence data coming out in the morning. Economists forecast that number to come in lower compared to March. The report giving us more insight on the consumer as inflation continues to be sticky.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But stay tuned. After the break, the latest edition of our video series Next. Akiko Vegeta heads out to Firefly Aerospace's ranch to see the future of rocket manufacturing. That and more when Yahoo Finance returns.
So start with hair nets.
This is to make sure that no particles are left behind.
Right.
What's going to happen to the lander? My hair falls
Just
in there.
spontaneously combust.
Don't want to risk the mission.
XL, we don't want that.
Yeah, there's a lot of XLs back here.
Come on in. So this is our clean room. This is where we do all of the assembly of our spacecraft. And you'll see right over here is Blue Ghost Mission 1.
The Blue Ghost lander is third in line to attempt a moon landing this year. Developed by Firefly Aerospace, the company's part of a new generation of upstarts seeking commercial success in a place few have gone successfully. Firefly is driving a mission armed with $112 million from NASA. Its goal? To develop a reliable delivery vehicle to the lunar surface.
One of the things that is a little bit different and unique about CLIPS missions is that we are taking a little bit more risk with each mission, but it gives us more shots on goal.
It's the new playbook in the space economy, driven by Elon Musk and SpaceX.
The missions that we're seeing right now are costing fractions of what they would have likely cost had they been run by NASA.
1/10 of the cost, according to the World Economic Forum. That's fueling private competition, accelerating production times and increasing launch counts.
We're learning from our experiences with our commercial partners. So it's a whole different way of doing the space program.
A program looking to stay ahead in the next phase of a global space race, crewed missions to the moon. This is what's next in the new space economy.
We're getting ready. Okay. So they're chilling in the engine right now. Last little bit.
Oh my God, that is incredible.
They say everything is bigger in Texas. And at Firefly's sprawling 200-acre rocket ranch, these daily engine tests are just a small part of the company's operations.
This is our first stage of that Alpha rocket. The second stage is actually on our test stand.
The mission here is to build an end-to-end space transportation company, with each vehicle manufactured and assembled in-house.
We launch, we land, and we orbit, and we're unique in that regard. There aren't many organizations out there that would say they do all three of those things as a purpose.
Firefly doesn't just launch rockets and landers. It builds orbital vehicles that stay in orbit, ready to repair, refuel, and relocate satellites. The company's successfully launched 3 rockets into orbit so far.
We'll have a lot of the same avionics on this spacecraft that we use for rockets. These right here are cold gas thrusters, and so those are the same ones that we use on rockets.
That reuse of materials is part of a push to drive costs down. In 2023, the company doubled the size of its facilities here to automate a big part of its production.
This AFP machine lets us build our Alpha launch vehicle structures in just 7 days and our medium launch vehicles in 30 days, which is a huge improvement over months with the more typical technology of laser-guided hand placement manufacturing.
9 times faster and 7 times cheaper, according to Firefly. It's one example of just how quickly commercial space companies are transforming a $630 billion industry. In this new space economy, it's the private firms driving the missions, with NASA as the customer.
How much of what Firefly is doing today, being able to own the full stack, is because of what SpaceX has proven out?
SpaceX and their presence created a bridge where we went from almost entirely government-funded and owned missions to a commercial infrastructure and a thought process that redefined how do we move with speed to get things built. If that hadn't been done, well, there's no way we could have taken inside of the timeframes we did.
That has saved the U.S. government a lot of money by getting a commercial business involved that is not only doing this for NASA, but is now a launcher across the board for commercial and other government payloads. And it's spawning off all kinds of new businesses.
That lower cost and ability to move quickly has transformed the business of space. Today, companies like SpaceX are launching every 34 hours. That's nearly 260 launches per year. The investments are pouring in. The space economy is now forecast to reach $1.8 trillion in roughly a decade. Growth has largely been limited to launch systems and satellites, but NASA's leaning on these private companies to take them even further. The agency's awarded $2.6 billion in grants to develop a low-cost transportation system to the moon to take NASA's research to the lunar surface.
We can survey the south pole of the moon before our astronauts ever get there.
And liftoff of the first United Launch Alliance Vulcan rocket.
We saw 2 attempts already, one Astrobotic that had a valve problem, and then we saw Intuitive Machines.
We can confirm, without a doubt, is our equipment is on the surface of the moon.
Had a soft landing on the South Pole. It sent back all kinds of data.
Firefly is next in line. Its Blue Ghost lander is set to launch in the second half of 2024 on board a SpaceX rocket.
We have 10 different payloads on this mission. We have everything from a device that samples lunar regolith to something that's testing GPS capability on the way to the moon, as well as a drill that's going to drill into the surface.
That mission alone will cost roughly $100 million, according to the company. Back in the 1960s, NASA paid roughly $660 million for similar missions when adjusted for inflation.
3, 2, 1. Boosters in ignition. And liftoff of Artemis 1.
It's all laying the groundwork for the Artemis missions, NASA's program to return astronauts to the moon. The first crewed flight, in partnership with Lockheed Martin and Boeing, is now set for 2025 after a delay.
What is NASA trying to accomplish this time around?
We want to go to Mars and beyond. We need to learn to live in a very hostile environment, to be able to supply ourselves, to invent, to create, in order for us to be able to send humans all the way to Mars and ultimately beyond.
NASA faces plenty of competition globally. More than 100 lunar missions are planned by government and private companies this decade, according to the European Space Agency. China is the biggest competitor. It's aiming to land its own astronauts on the moon by 2030.
Why is it important for the U.S. to be first, particularly in the South Pole?
I think that since it's very clear that China has announced that they are going and intend to go to the South Pole of the moon, they've said that they're going to set up a research station. All that's good, but I think from past experience with China on the face of the earth, I think it's not beyond the pale that China would suddenly say, we're here, you stay out. And so that's why I think we're in a space race. To get there to the very promising South Pole of the moon. Why? Because we think there's water there. And if there's water in abundance, then there is rocket fuel. And that gives us a gas station on the South Pole.
Commercial revenues already make up roughly 80% of the global space economy today. That share is expected to get even bigger, raising concerns about relying too much on the private sector.
In the past, NASA very much has been a civil organization that works very closely with the Department of Defense. And many of the technologies that go into space are controlled by the US federal government. The risk is that you start to put more and more of that into industry, and you're now beholden to the expertise and experience of industry, kind of in the same way that you are with a lot of the aerospace and defense industry as it exists today, where you have a few set of very powerful primes who are great at what they do, and they develop some of the most amazing advanced technologies out there. But the government no longer owns and controls a lot of those assets.
Martinez also says there's an added risk to publicly traded companies. Intuitive Machines stock tripled in value in the lead up to its moon landing, but it fell more than 30% once shareholders learned the lander had tipped over, preventing its full mission from being completed.
This industry is very difficult, very speculative, and there's a lot of risk in it. And it is hard to go at the pace that you need to go and to take some of the risks that you need to take if you're focused on near-term value for shareholders.
Firefly's remaining private for now, adding speed to its equation. In 2023, the company launched a satellite into orbit 27 hours after receiving the order, shattering the previous response time of 21 days.
I just keep thinking that, what you hear from commercial companies is, we're more nimble, we can move quicker, we're more aggressive. Is safety being compromised in all of this?
No, you can't lose missions. You can't endanger people. There is no business plan that survives any amount of speed and agility if you're hurting people and you're not protecting a customer's investment.
Companies are exploring opportunities beyond unmanned missions to the moon. Startups Astrolab and Intuitive Machines are building their own vehicles with NASA funding to shuttle Artemis astronauts around the lunar surface. Firefly's racing ahead with its own plans. The company's now building a medium-sized rocket with Northrop Grumman so it can launch its lunar lander without the help of SpaceX. And it's moving into lunar missions independent of NASA.
We believe there's enough demand out there right now for us to schedule a Firefly run lunar mission using that platform behind us with 100% commercial payloads on it. Now,
No NASA funding.
No NASA funding, but isn't it interesting? NASA might be one of those tenants. NASA might say, hey, great, glad you're running that mission. We'd like a spot. And that's where this needs to go. Commercial industry, much like we plug into the wall and say there's electricity there, commercial industry needs to be running that transit. And the government, instead of being the prime contract driver, will utilize that capacity. There's most definitely enough demand on the commercial side to tell Firefly, the indicators are there, let's announce that mission.
How important is it to get it right the first time?
Nobody is limiting our capability to, hey, it'll be great if we just make an attempt. We're gonna put that lander down exactly where it needs to go on the Mare Crisium on the surface of the moon. That's the mission. That's what we signed up to. That's where everybody's focus is. We're in these to participate in these missions now, learn everything we can so that when the commercial lunar market evolves, we're ready then to scale it. I think our focus, though, is making sure that no matter how many winners and losers there are, Firefly's one of the winners, and high degree of confidence that's going to be true.
For more on the key aspects to the new space economy, Yahoo Finance's Kiko Vegeta is joining us now to discuss. First of all, Kika, how freaking cool there's all
that
this
rocket
stuff.
ranch.
I mean,
I have to tell you, I mean, it's pretty
amazing.
incredible that they do all of that within that ranch.
And also when you hear the NASA administrator talking about finding water on the moon, that could be sort of the way station, the fueling station, it's just really cool stuff. So obviously we have come a long way in terms of the privatization of the space industry. What's the sort of next step in maturation in terms of making money, in terms of it being more of a real industry?
Yeah, I mean, when you think about commercial space today, it's still very largely limited to rockets and satellite launches. Obviously, we talked about that in our story. SpaceX is absolutely dominant in that. There is that next phase, though, that a lot of these startups are looking to, which is, number one, if you can get humans to the moon successfully, if you find the resources, then that, as Bill Nelson said, becomes a gas station that gets you to Mars. And ultimately, that is the end goal for so many of these companies. Now, separately from that, there is a timeline for the ISS retiring. Now, you've got, if you look at the last few decades, it's been the International Space Station. That's where the cooperation is had. Now you have the ISS, you've got the Chinese with their own space station, and you've got commercial companies like Blue Origin getting in as well. So that's a lot more fragmented. But when you ask, like, what does that mean for commercial companies? Well, those are even more opportunities. There's already pharma development that's happening on the ISS. That could become even more commercial because you've got so much real estate you can go to within orbit.
And Kiko, and just taking a step back, we were talking off camera about this kind of like explosion of interest in space startups. I mean, some of these startups have raised a ton of money. What's driving all that? I mean, part of it, you talk in the piece about declining cost of rocket launches, one thing, but it sounds like some credit's going to SpaceX as well here.
I think all these startups would say it's SpaceX. Yeah. They set the roadmap, the template for these companies to follow, which is why we talk about the new space economy, right? If you think about where things were, it was so much dominated by NASA, by governments. That's not where things are today. But what's interesting to me is there is the satellite launches, rockets. That's the commercial side of things. To your point, Julie, that you asked off camera, when do lunar missions become commercially, when does it become profitable? We put that question to Bill Weber over at Firefly, and he said, look, it usually takes about a decade. He's sort of looking at that, but he has seen a lot of commercial demand. Those companies out there that have seen what NASA's doing in partnership with Firefly and Astrobotic, all these other companies who are saying, I want to take my research to the moon. I don't have a means to do it, but can I pay you to take it there? And so because he sees that demand, he says the path to profitability is there. When you think about where Firefly is right now, they can do these missions because they have a lot of revenue coming in from the rocket launches and the satellite launches as well. So you've got to be a little more diversified. That's at least the message that we got from so many of these companies.
Very quickly, are there any risks of privatization?
So one of the things Matt Martinez from BCG talked about is that before it was all about NASA, the government owned the property, the assets. That's not the case anymore. And we've had these conversations over the last several months with Elon Musk and what he's saying on Twitter. Is there a risk with him, sort of talking about these things when he has government contracts with SpaceX? There is a risk of SpaceX having so much of the market. That's a question that's been raised. That's something that Matt Martinez talked about as well. But, look, the reality is they are driving the space exploration right now, but NASA is involved in the oversight, and they have said very clearly, if it's not safe, we don't want to move forward with it.
Akiko, great reporting, awesome story. Thank you. Coming up, shares of Chegg sinking after hours. The company announced a shakeup at CEO. We'll get you the latest on the other side. Lamborghini unveiling the newest version of its best-selling SUV, and you can plug it in. For more on Lamborghini's new hybrid, we have Yahoo Finance's Praz Subramanian. Praz.
Yeah, the Urus is going green. You can plug it in, but it's not just about the green elements and they said 80% less CO2 emissions. It's about horsepower and performance. almost 800 horsepower, 40 miles of electric range, but also it's more about that extra oomph you get from electric power. And I spoke to Lamborghini CEO Stefan Winkelmann about this car and about whether or not they have a big EV plan, right? The question is, are hybrids pushing out those plans to not kind of pushing the EVs out of the picture? Here's what he had to say about that.
We live in the here and in the now, so it's a bit useless to ask what is going to happen in 5 or even more years. But what was difficult to be accepted maybe 5 years ago for a super sports car manufacturer like us, today is no matter, it's digested. So the hybrids are digested because we promise more performance and less CO2 emissions.
So he's talking about this recipe of hybrid performance that also gives you both the performance plus also the green elements of it. And he's saying that the buyers have sort of digested the fact that this is what we want. We want hybrids right now.
Interesting. And so what does the luxury market look like? We've been talking a lot lately about how the EV market has been waning, at least for now, and people want hybrids. Is that true on the luxury level also?
Yeah, I was a little surprised to hear that actually there's not a kind of taboo against a battery-powered car here, or a partially battery-powered car. This is a $260,000 car, and he said that it's sold out for the next year through 2025. So that's pretty high demand for a car that isn't not just your standard V8 kind of powered car.
I mean, listen, if you spend $260,000 in a car and it doesn't have that oomph, obviously they have to figure out a way to, because hybrids do have that sort of stereotype that they don't have the same power that a traditional gas-powered car has. So if you're going to put that price tag on it, you better deliver that power, I guess.
It's got to sound good. It's got to make all the right sort of the vroom, the startup, and also the quiet, kind of cool electric drive. You want to have all that. So you mentioned the luxury consumer, yes. So whenever I get a chance, I like to speak to Stefan about the consumer there. It's a very high-end, well-heeled clientele, and usually they've been sort of reacting to high rates, and they believe it or not, they do have issues with stuff like that. But speaking of America, at least, he says that the American market is still pretty strong, and it's their top market. So here's what I'd say about that.
This is the largest market for us, the US market, by far. In comparison, the Chinese market is much smaller, even though the automotive market is bigger. When we speak about luxury, for us, we have to sell locally, but our cars, they have to fit in the same way in the entire world. So it's a very complex approach. We are not talking about fashion or accessories or watches, where you can have something locally and you can buy it wherever you want. So let's say that the effort we have to put into the development and the cost of the cars is by far higher and more complex than in other luxury businesses. And for us, I have to say that there is no weakness in the world.
So you kind of took a while to get to the point where you said there's no weakness in that world right now for the luxury consumer, but even for products that have to be so localized for each area, still very popular, still very strong. Sales are strong here, even for these sports cars.
Very interesting. Thanks a lot, Pras. Appreciate it. And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.